Well, good afternoon, everyone. I'm here today with Megan Quinn, and we're here for another edition of FundersClub Live, where we seek to bring people from the industry of venture capital, from tech, from startups to you guys who are out there all over the world. We have people tuning in from, I think, every continent. To
Antarctica?
We'll
Is there a research scientist
we'll
out
see.
there
If you're in Antarctica, let us know in the comments. We'll want to talk to you. And really our goal with this is to have as unfiltered a conversation as we can, as real of a conversation as we can, involve more people in the dialogue around venture capital, and also make it less of a black box. And Megan is an amazing person. I'll keep my intro short. I think one learning we had last time is the questions are just fascinating that come in, and they lead to great conversations. So we'll try to shift very quickly into Q&A here. But I did want to give a brief intro on Megan. I know she's too humble to brag about herself, but she's extremely accomplished. At Stanford, led product and marketing work at Google, including the rollout, the development and marketing of key products like Google Maps, as well as moving on from there to director of product at Square, and actually transitioning into the world of venture capital directly at Kleiner Perkins as a partner, overseeing investments in companies like Uber, companies like Slack, and currently is a partner at Spark Capital. So it's a pleasure to have you here today.
Thank you for having me. This is my first Facebook Live.
Wow, all right.
So I'm ready for whatever happens.
Cool, all right, let's do this. So let's just start. So I encourage anyone listening, anyone watching live, please ask anything. Post your questions. Hopefully we can get to them. There's a lot of questions we've already got queued up here. We're just going to read from the screen, and we'll get into a cool conversation. So kicking off, this is questions from Pedro. So you had almost 10 years of operational experience before moving into venture capital. How is that transition from being an operator of a tech company to being on the investment side? And what lessons from that other side of the table have you been able to bring in as to the investing side now?
That's a great question. It's one I actually don't get asked as much as you might think. I'm a strong advocate for people who are interested in being investors at some point in their career, actually working in the industries within which they want to invest. So in this case, working in startups. Google was surprisingly a startup when I joined. Now I'm aging myself.
What year was that?
It was end of 2003, beginning of 2004, so it's about 6 months before the IPO, about 900 people.
Yeah.
And Square, of course, was about 20 or so people, so that was another startup.
Sure.
And I think that operating experience, seeing Google from, let's say 900 to 30,000, something like that, and Square to something like 20 to 450, really gives you an understanding of the challenges that startups face at every step along the way of their journey. And that's been incredibly useful for me on the investing side, really because it gives you empathy for the person that's across the table from you, whether or not you're frankly an investor of theirs or not.
Sure.
Being an investor is an incredibly humbling experience. People come in, they tell you their dreams, they tell you this vision of the world that they believe should exist, and 99.9% of the time, certainly in my case, unless they're talking about maps, they know a lot more about what they're talking about than I ever will, frankly. Sure. And so I'm there to learn and listen and then pass judgment. And because I will never be the subject matter expert in whatever it is that they're focused on, the empathy and experience that I have of frankly just building and helping mature startups over time is actually really useful to those entrepreneurs, or at least that's the feedback I get.
How do you, this isn't a question from the audience, but just riffing off of that, the question that came in, how do you tell the line in terms of as somebody who's led product development, and you're talking to founders building product, building technology companies, how do you tell the line between being an advisor and sort of mentor, and when you witness something that you just feel is maybe off base, and maybe you've seen this before, and you know that 10 months down the road X is going to happen, and do you resist the urge to share that because this time it could be different? Do you actually just put it all on the line? And
I share the information because I think actually most good entrepreneurs want to learn, and they're looking for inputs and feedback everywhere that they can possibly get it, and then in their own head and in their own company, they're sifting that down to what's actually applicable to their business and their products.
Sure.
I am a sort of relentless advocate for great products. I love products. I test, even though I'm a later stage investor, I test very early pre-launch products all the time to provide feedback. And part of that is just as a normal consumer, as someone who enjoys testing a lot of products, I'm happy to do so. And then part of that is saying, like, hey, you know, we tried 32 different variations of this when I was at Square, and this was really what worked, and it seems like it's applicable to your business for this reason. And that kind of feedback is what tends to get sort of the most appreciation from entrepreneurs I talk to. Certainly I can't go in and say, and never would, this is what you have to do.
Right.
But what I can do is say, here's a template for what I've seen and what's worked. Maybe it will work in your case and save you some time or some energy and effort doing things that won't work.
Cool. All right, let's go back to the audience. So this is a question from Elizabeth. What level of financial literacy do you expect of your founders? So what this person, and they go on to clarify, for example, is a good handle on the books enough, the financial books, or do you prefer them to understand things like cap tables, percentage distributions, et cetera?
I mean, to be clear, startups, at least the ones that I'm looking at, they're not nonprofits. These are businesses. If they're not a business today, they are intended to be a business over time. So yes, you should have a basic level of competency in the business of a startup. The good news is that there's a proliferation of VCs like myself who share a ton of content online every day, all the time, more than anyone could ever possibly want to read about the fundamentals of startup businesses. What I really do is...
Where can they go to read your stuff, by the way?
Oh, my stuff. My stuff is actually more of an opinion on products, less on the business side, which is always on Medium. I'm an investor, so I'm very biased.
Sure.
But what I do definitely tell people who are new to entrepreneurship or new to investing is go read Venture Deals by Brad Feld. I actually don't know Brad. I've never met Brad. I get no kickbacks.
Hi, Brad. Brad is out there somewhere.
Yeah. From recommending his book. But the reason I recommend it to people is because it's about 200 pages and it just goes through what are the very basic fundamentals you need to understand about running or investing in a startup.
Cool. Awesome. Maybe we can come back to like books that you'd recommend later as a thing. Yeah. But audience question. So this is from Sachiv. Monetization has always eluded many startups. In the last 12 to 18 months, how do you see a shift in the balance as startups kind of might be shifting to reflect the macro situation more towards monetization, maybe away from growth? Maybe it's not a shift, but that certainly has been out there. And what do you think about that? Basically, like monetization being sometimes something that's hard to fully capture when you've sort of been surrounded by an environment focused on growth.
Yeah, I don't think monetization has eluded many startups per se. All the best entrepreneurs I talk to, even if they have a pre-revenue generating product, have a concept, an idea, a philosophy, a theory around how they will monetize the value that they're capturing. And so I don't necessarily know it's eluded in the sense that people haven't been able to imagine or understand what it could be. It's just a very fine balance, right? It's a trade-off between high growth at all costs, which was frankly a couple of years of our industry, both as from a startup perspective and an investing perspective, and a realization that actually, no, we need to maintain the fundamentals around a business at the same time appreciating the benefits of growth. And so it really is this seesaw per se, and a lot of it is psychological.
As a growth stage investor, would you be still interested in funding a business that is sort of net losing money, doesn't have a monetization model now, but it still could in the future or does in the future?
I am a delighted investor in a couple of companies, not the majority of the portfolio, but a couple of excellent companies targeting really hard problems for enormous user bases that have seen incredible growth, that are pre-revenue or nearly pre-revenue, but have very, very distinct paths to revenue. Not ones that they've never thought about, nothing they've ever spec'd out, ones that we have actually had conversations about, and it's just a matter of implementing or growing the team in order to put them into practice.
Cool. All right, back to the audience. So this question is from Dan. Is it rare for a technology startup, a tech startup, to make it big without having VC funding?
Yeah, this is such an interesting question because we exist here in San Francisco in the Bay Area. We exist in this bubble, right? Where if you want to start a company, you go out and get VC, and it doesn't matter if you're starting a women's intimates company or you're starting a food company, like venture capital is for everyone, and that's the mentality that we have here. When in fact, that's actually not the reality. Like venture capital is a very specific type of funding vehicle for a very specific type of company. And it is not broadly applicable, and there is no reason to have shame or to be disappointed if venture capital is not the right funding vehicle for you. I mean, the United States is built on small businesses that do not take venture capital.
Right.
So is it rare for a technology company? I would say no on the macro perspective. Certainly in the Silicon Valley perspective, yes. But as a result of, frankly, a lot of the very, very expensive companies and high valuations that have popped up in the Valley over the last couple of years, a lot of my colleagues and of my ilk are actually going out and looking into places in the middle America, sort of what we wouldn't perceive as first-tier tech locations, for example, to find more of these companies that have been doing the hard work of building a product, building a team, building a company quietly without the sort of inflated aspects of Silicon Valley.
Sure. So I think just riffing off this, because it's important, it's not necessarily an audience question, but you made this point, and I totally 100% agree. Like, I think the stats are half or more than half the companies that go on to IPO, for example,
have
never taken VC money.
Never.
And so for sure, like, there's no shame in building a business without taking VC. It shouldn't be the end goal.
I should add, like, my father has a law firm he started in 1982. It employs 3,000 people, 20 offices globally, but law firms don't take venture capital, right? And he's done very, very well, and so have the people that he's built that company with. So.
Yeah. So, but that being said, I think the interesting follow-up question then is what type of business is, like, what would be a good fit for VC then? And you kind of got at it in your answer earlier, but I'm just curious to riff off of that.
It's really around super scale, right? Where venture capital dollars will enable a certain amount of technical innovation to then scale extremely quickly. And I think that we have sort of expanded the reach of what venture capital has traditionally been for a little bit in recent times, but it's really around scale and ambition of scale.
And sort of to put, since some people in our audience might not know what you mean by super scale, like what would be an analogy or a benchmark?
To be a global company offering products to every person on the planet as a benchmark.
So like not a high bar or anything. Cool.
Or to revolutionize an existing industry, from the outside. I mean, those types of businesses.
Cool. So back to the audience. This question is from Reed. I'm a college student and was interested in interning at a VC firm. Any advice on what steps to take and what experience I should have already acquired?
So I have strong views on this. I'm amazed that there's anyone that wakes up as a high school student, a college student, and gets out of bed and is like, man, I just want to be a venture capitalist. Like, the thought never occurred to me, and the fact that it occurs to somebody, I am in awe and I appreciate, but it's unbelievable. So coming back to sort of the first question that we had in our Q&A, I really think, and this is my perspective, obviously built on my experience, so it's very biased, but I think the absolute best way to get into venture capital is to go work at a startup. It doesn't matter if it's 5 people or 20 people, but let's say not 500 people. Go work at a true startup where you can have an outsized opportunity to have an impact, excel, work extremely hard. And by the way, if you're really working hard and you're doing great work, you will meet the investors of that startup and you will meet other investors as a result of that, and just really prove sort of your operational chops and your network within the startup community, and then move over into the investing side. I mean, that's my strong bias. There's a lot of people who've gone different routes. My husband was a journalist. He is now an investor. There's certainly another famous journalist at Sequoia Capital who's now an investor. There's not one route, but my bias is to actually go in, get your hands dirty, and learn what it's like to actually build a company.
Cool, yeah. All right, this question's from Siri. You've written about learning by observing, about how in the age of transparent public communication, almost anyone can be a mentor. Who are your mentors in VC, and who are the people you followed, observed, and learned from when you started out in venture capital?
That's a great question. So this is one of the few things I've written about. I'm not a prolific blogger, but I do have this belief that mentorship is extremely important, but mentorship does not mean someone that you meet up for coffee with every other week necessarily. It's definitely good to have people who are specifically focused on you and invested and on your success, and who will spend that sort of time, but that if you pay close enough attention to people and how they act and behave and write in public, you can actually learn quite a bit. And so that's what I talk about when I say learning by observing.
So meaning to say, if I'm hearing you correctly, that you could have a mentor figure who you've never met?
Who you've never potentially met, right? It depends, of course, on how transparent they are, but a lot of people, frankly, maybe too many people in our industry are very prolific online in terms of the content that they create and share, whether it's on Medium or Facebook or Twitter or where else. And so I've given some examples of this. On the operating side, it's not a perfect example. So Marissa is someone that is a friend of mine, someone I've worked for a long time, but as CEO of Yahoo, she's very busy. I don't ask her for coffee every week and see what she's up to and get her feedback on my latest life decision. But I know enough about how she thinks and how she writes and what she shares to be able to learn from her experiences that she's had from a third person view and come up with lessons that I can learn from that. And that same thing is exactly true on the venture capital side. The good news about VC, or at least from my experience coming into VC, is that the community itself was extremely welcoming. So I would say a general partner from almost every fund that you would think of on Sand Hill reached out, wanted to meet up immediately when I sort of crossed from the operating side to the investing side, and were really willing to share the lessons that they had learned, the things that they thought I should be thinking about and doing right away, and I continue to develop those relationships. But there are some people, whether it's Bill Gurley or Mark Andreessen, who I don't call up every week and see, what do you think about this deal I'm looking at? Here's how I'm thinking about it, so. But they're actually very prolific in their writing. They're very thoughtful about it. And so I can learn from the experiences that they've had over 20, 30, 40 years in the industry.
Sure, yeah. And I would say observationally from the outside, that seems like a rather new phenomenon, like the last
Completely. It's something that we really benefit from in a world where people are readily sharing their perspectives and view. And frankly, it probably is one of the reasons that investors are encouraged to share what their learnings are vis-a-vis each deal or each investment that they make. So.
Cool. All right, so.
I would also be remiss not to give a bunch of credit specifically to John Doerr and Mary Meeker in that, though. John was on my board at Google. Mary was on my board at Square. They're both phenomenal people and amazing investors, and if people have an opportunity to work with them, I would tell you now, take it. They're wonderful people. And they also both individually spend a tremendous amount of time with me. But that was more of a relationship base versus learning by observing.
Got it. Cool. All right. So this next question is from Dan. It's phrased rather formally, but please provide your top 3 criteria for making an investment decision, positive and negative. So 3 of each. So maybe we can, maybe just to distill that down, because we want to get through some of the other questions as well. Perhaps just like something or 1 or 2 things that stick out as like a positive, 1 or 2 things that stick out as a negative.
I can be quick on this. It's for me in this lineup, every investor will include these 4 things in their lineup, but they will change the order. For me, it's product, entrepreneur, market, business model.
In that order, you mean?
Vaguely, yes. Vaguely, if they're not all stellar, it's not a good fit for me, so they have to all be of that bar. But as a product person by background, that's what I'm first initially attracted to. Obviously the person, there's got to be some sort of charisma and relationship there. And then it's how big is the market they're targeting and what's the business model.
Got it. Cool. Okay. Awesome. All right. This next question is from Jitendra. What do you think of startups in the space of the sharing economy? I mean,
so I actually don't love the sharing economy phrase necessarily because I'm very selfish and I don't share very much. So I am an investor in Uber and an extremely happy one. I think that they've completely revolutionized transportation, will continue to do so globally. My husband and I both sold our cars. I'm from Los Angeles. Selling my car is like,
it's a big step.
It's like selling a child in some respects, It's like I was born and raised that the car was your home and you were entitled to it, on the 101. So we both sold our cars 2 years ago and are all in on Uber and public transportation and good old-fashioned walking. And it's completely changed our life and our economics. So we actually did the math, and this is one of my other posts that I put on Medium, about doing the math for our household between owning two cars, in San Francisco, and depending entirely on Uber and transportation, public transportation, and walking.
Sure.
And it just made sense for us, and not necessarily for everybody, but it's math worth doing. So I'm obviously a big fan in that regard. In terms of do I need to share my blender, there have been a lot of these companies that have popped up in the micro sharing space. You really don't use your blender every day, so maybe your community should share a blender, and I'm not enough of a hippie for that. So I think the share economy is great up until a point. I'm certainly a big fan of Airbnb and multi-time user, but I think that maybe we've extended that framework as a business model a little bit too far.
Got it. Cool. Okay, this next question is from Lorenzo. We always hear that the best way to get a VC's attention is through a, quote, warm intro. What if you don't have a large personal network yourself? What's the best way to get in front of a VC who you may not actually be able to get an intro to directly from your existing network?
I mean, this dovetails well on what we were just talking about in terms of VCs tending to be very active and engaged in lots of different public forums, whether it's Medium or Twitter or whatnot. I actually think it's never been a better time for someone who doesn't necessarily have a public presence, but who wants to meet people who are influential in making decisions at a certain level in Silicon Valley, to be able to do so. Because actually all you have to do is communicate.
Right.
And that sounds trite, but become a subject matter expertise in something. Having a strong opinion, back it up with fact, write about it, share that opinion broadly, and people will engage with you. It's just the nature of Twitter, for the good and the bad, frankly.
Right.
But I think that that's really the best way to engage with VCs if you don't necessarily have a large network innately.
So make it apparent that you are an expert in something or have a strong point of view in something.
Yeah, I mean, what I said at the very beginning, which is, I'm sitting across from founders every day who know 99.9% more about whatever it is that they're focused on than I do. Share that knowledge, share that learning, share that enthusiasm and passion, and do so broadly, and then engage with people around what it is that you know, and you will be a magnet to people.
Yeah, that's really, really good advice. So this is from Michael. From Ryan. What kind of, so you were at Kleiner for a few years, now you're at Spark. Sort of what's been the evolution of your career as a VC? How is what you're doing now different from what you're doing before, and similar maybe?
I get actually asked this question a lot. It's a good question.
Okay.
So about moving from Kleiner to Spark. Kleiner's an amazing place. Like I said, I'd known John and Mary as respective board members at Google and Square, and they were kind enough to give me an opportunity to come into Kleiner and do early stage investing with them. And look, I don't think that in Silicon Valley there is a better place to learn the fundamentals of venture capital than Kleiner. It has 46 years of history. They have seen every machination of deal, of company building, every challenge, all under one roof. And so when you're learning, when you're going from an operating side to this whole new world of investing, that is an amazing place to learn. You're learning from the best. I continue to stay extremely close with them. The big thing that I was looking for coming out of a number of years working at Kleiner was really the opportunity to be a part of something that was building, right? So Kleiner has this reputation, and it's an amazing reputation, but frankly, I can't take any credit for helping build it. And part of the opportunity at Spark was really to say, look, we have 10 years of history, and it's a great venture firm. It started out in Boston. They're certainly beloved by both entrepreneurs and other investors, but we were getting into the growth practice for the very first time. And this was a new competency for the firm, and it was something we hadn't done before, and we had to both prove ourselves as growth stage investors and frankly prove ourselves as San Francisco-based investors, because the office is only a year old here. And so I really wanted to go to a place where I could be a part of that building process.
Sure.
And so it's been a great fit.
Cool. By the way, for those not super familiar with how, I guess, the VC industry works, I think it's fascinating how humble, I guess, the way that you answered that question was, just in the sense that, I mean, Spark is a firm that backed Twitter and Oculus, and to think that with those successes under the belt of the firm, there's some proving out still in that sense. So it's quite,
We have a lot of work to do.
Right.
We have a lot of work to do to continue to build up our reputation, continue to meet more entrepreneurs, and like I said, to develop this growth practice, which is relatively new for us.
Cool. Okay, another audience question from Michael. So with reference to VCs looking outside of Silicon Valley, you had referenced that earlier.
Yeah.
I think this is in response to that. How can an entrepreneur reach out to investors outside of sort of tech areas?
And how can we know which they're interested in? It's not necessarily networking alone. So one piece of it, like I said, we've already a little bit touched on, is share the subject matter expertise that you have. Have a strong opinion, say it loudly on Twitter. I promise you, people will engage. We've seen that for better and worse over the last couple of years.
Sure.
But certainly the way that we become familiar with and aware of great companies that are outside of the bubble that we live in or in Silicon Valley is by talking to local investors. So there are seed investors in all of these markets, whether you're talking about Detroit, Atlanta, Utah, Pittsburgh. There are local seed investors who spend a lot of time with their communities, and they reach out to investors in larger markets and say, hey, we really see something special here. And all it usually takes is one introduction, and then investors start, oh, you know what, I should really get smart on that whole market, and I'm going to spend a whole bunch of time. And that's what's happened, for example, in Atlanta with regard to security companies, and definitely Utah with regard to enterprise software companies. So it really just takes that little spark. But I really, like I said earlier, I think that we've never been in a better time to be able to engage directly with someone regardless of location, based on having conviction around an idea, a product, or a business.
Sure, cool. So this question is from Chris. What is Spark's take on a startup's use of nearshore tech dev teams to help startups with their product pushes, and is there a downside from a VC standpoint?
Yeah, VC standpoint versus product person standpoint, which is the constant internal battle I have. Yeah. From a VC standpoint, we see a number of great companies that have some portion of their technical teams outside of the United States. And it's attractive in many ways. Obviously, there's great technical talent outside of the US. To say that there isn't would be oblivious. And it's less expensive, right? There's not much competition necessarily around talent. And so getting a product and a business and a company up and going with some external technical talent isn't an immediate negative thing from a venture capital perspective at all. From a product perspective, which is where I'm going to shift a little bit, it's very tough for me to imagine what that would be like. And I think it's not necessarily a bad thing. It's just yet another existential challenge that you have as a startup when you're building, when you have so many challenges in the first place. Yeah. Because I know based on the dynamics of engineers, designers, and product people working together, that actually proximity is pretty crucial to a lot of the development. And so I think it's not necessarily bad, but you're just throwing in yet another challenge and hurdle into the building process.
Got it. Okay. So I'm hearing a strong preference for in-house
product. That's personal. That's personal to me, and not necessarily true of VC across the board.
Yeah. Cool. Question from Matt. Interesting. Spark has a mixed history of funding ideas versus true seed. So I think this is referencing sort of the stage of the company from MVP to sort of maybe Series A. So what's the current thinking and appetite at Spark for stage?
Yeah. So we have a venture capital, it's existed for a long time, early stage fund. And they're focused on seed and Series A. And if anything, they are leaning into risk. So when you said Oculus, they were the folks that invested in Oculus. They were the folks that led the round of Twitter. They were the folks that led the Series A in Cruise when everyone was like, who would ever do like a third-party autonomous vehicle startup at this point? Yeah. And so my partners on the venture stage are looking for very risk-heavy investments that are truly new ideas, new products, and new spaces. And that's what they're spending their time on. Yeah. I would say on the growth side, which is where I sit, we're looking for products that have product market fit and business models that are either sort of already ready to be replicable and we just need to pour gasoline on the fire, or where there's a very clear idea of how to monetize a very large user base. Right. But I would say from a sort of macro perspective of where this question's coming from, it's definitely looking for, the venture team is definitely looking for seed and Series A's investment that are novel and new. I will say that there's a bias to actually have a product a little different on the hardware side, when product takes a little bit longer to develop. On the software side, the expectations are now higher from venture capitalists, that there is at least some sort of working demo that people can use and feel and play with.
Even at the seed stage, you're saying?
Yeah. I'm not saying it has to be perfect.
Yeah, cool. All right. So this is Josh and Nick, I guess, and so we're sort of combining two related questions together. So basically question one, There's sort of now ways to raise money online, investment platforms, for example, such as FundersClub. And basically, do you have a concern that the best companies won't be invested in by these platforms? Hold on, let me reread the question. Do you have a concern that the best deals won't go to these platforms and will be scooped up by investors sort of offline who have access earlier? So that's like one question. Follow-up question is like, would you consider it a negative if a startup received funding from like an online source of capital at the seed stage?
So we're threading a couple needles.
Yeah.
But my general feedback is no, I wouldn't consider it a negative if a startup received crowdsourced funding at all. And certainly that's true even more so on the growth stage, because if you've received crowdsourced funding and you've made it to where we're focused on, that's the company's doing tremendously well. And am I worried about platforms not being able to have access or exposure to these kinds of deals? No, for all the reasons that frankly we've been talking about over the duration of this conversation, which is there are great companies being built all over the world, places where venture capitalists don't sit, frankly won't even go. And this is an opportunity for them to have real, true exposure to a financial vehicle. Exactly.
Yeah. Cool. All right. Wow. There's more questions than I think we have time for today. Maybe we'll take one last one, and then we'll have to call it a day. But I could imagine sitting here for double the time and having a great time. But so this last one's from Mark.
People are hungry though.
Yeah, we are at least in the West Coast. We're sitting between people's food. Elsewhere in the world, I know we're sitting between dinners. So this is from Mark. This is a good question. So obviously Spark is one of the best VCs, but how should we vet our VCs? So this is speaking from the founder's point of view. How should founders vet VCs so they can get helpful advice, good energy, along with the knowledge of how to get out of their way? Basically, like everyone knows VCs are picking startups, but like presumably founders are supposed to be picking their investors.
We're interviewing too.
So,
every conversation I have with an entrepreneur is an interview on my part as much as it is on their part. I think actually the most critical mistake that entrepreneurs make, and they make it frequently, is when they come in and they say, I really don't want to take very much time doing this fundraising process. I'm hoping to wrap it up in the next 14 days. And in my head, all I can think of is, man, maybe you've gotten to the wrong business. Because fundraising is fundamental to this business. And if you want it to be some fast process, then that says to me you don't really care who the people are who are going to be helping you build this company and who are going to be investing. And frankly, Jack taught me a lesson very early on before I was even thinking about being an investor, which was investors and board members are employees that you can't fire. And you really need to internalize that as an entrepreneur. And so when you say, no, I just want to wrap this up in the next 10 days, it says to me like, you're not really thinking about your investors in that way and the way that you should be.
Right.
So actually my response to that in terms of how would you vet is really to spend time. And you should spend time not in one sort of individual partner meeting and then a whole firm pitch meeting. You should really spend time getting to know each other.
What are like one or two axes or parameters of evaluation when you're spending time with that VC, like to look out for as a founder?
I think actually the first one is like the personal connection piece.
Yeah.
Like again, going back to the employees you can't fire. This is someone who, whether or not they're on your board table or on their cap table, like they're going to be there for the duration of your business, and it's someone that you are going to want to bring along. So I think that's extremely important. And the second piece of that is really just competence. Like, is this someone who, if they don't have domain expertise, do they have broader platform expertise that can be applicable to your business and helpful?
Cool. Great. Well, thank you everyone for participating today. We have a long list of questions that are still unanswered, so hopefully we'll be able to get answers out in one way or another, but really appreciate everybody joining today.
Thank you for having me.
Yeah, Megan, thank you so much for joining.
Appreciate it.
And yeah, thank you.